And we are live. Hey guys, welcome back to the stream. It's 4:45, bit late. Uh, I didn't have a snack like yesterday. I realized I told you I talked about this yesterday, right? Having an empty stomach is good actually for work and for stream. But I had tea, had black tea, and I just woke up. Welcome, guys. Welcome back. Welcome back. Okay, so today we are at chapter 14, the Federal Reserve Act of 1913 and its provisions. So, we, yeah, yesterday also we discussed the before Federal Reserve establishment, like the Andrew Jackson, the second bank we discussed, and we discussed a bit about the just before the establishment of Federal Reserve, what caused it, the Jekyll Island meeting and all. We discussed about that and what are the roles they were intending for the Federal Reserve to be, and we'll further discuss. I just started, man. I just started the stream. Why? Why? I just started the stream. Shit. Photic sneeze reflex. Yesterday and day before yesterday was relatively fine, right? I think just me like acknowledging that this can be a problem is not causing the problem, and today I didn't even mention it, so now it's acting up. Okay, fine. That problem can happen. So don't don't happen. Yeah, this is the request for me to me. Okay, guys. So that let's get into it. The historical context of the Federal Reserve Act of 1913. The historical context of Federal Reserve Act of 1913 can be traced back to the Panic of 1907, which was a severe financial crisis that shook the American economy. The panic highlighted the need for a more stable and flexible banking system. Okay, 1907 require a more stable and flexible banking system that could address the liquidity issues faced by banks during economic downturns. The existing Sadie Gilbert, hi Sadie. So okay, so we are learning this. Hola, okay, hola. I only know hola. So I'm reading this book. So it's about the evolution of the financial systems. Okay. The existing banking system was unable to provide adequate credit and liquidity to stabilize the economy, and the government lacked a central mechanism to regulate the banking system. In response to panic of 1907, Congress established the National Monetary Commission in 1908 to study the banking system and propose reforms. The Commission spent 5 years conducting research and drafting recommendations for a new banking system, which eventually became the Federal Reserve Act of 1913. The act was signed into law by President Woodrow Wilson on December 23, 1913, after it had passed both the Senate and House of Representatives. The Federal Reserve Act of 1913 aimed to create a more stable banking system and provide a flexible monetary policy to stabilize the economy during financial crisis. The Act also aimed to provide a more efficient means of clearing and settling transactions between banks and to establish a more uniform banking system throughout the country. The Act's provisions created the Federal Reserve System, which remains the backbone of American banking system to this day. So yeah, the Federal Reserve System is actually existing even today, and we'll actually further discuss its involvement in all the uh, important events, financial events. Nightlights, rough, great hairman, G's. Hey, thanks, man. I don't know if you're kidding or not, but anyway. I'll take it as a compliment. Thank you, bro. Nightlights riff. Okay, the background and motivation for the creation of the Federal Reserve System. The creation of the Federal Reserve System was a response to the financial panics and banking crisis that had plagued the United States throughout the late 19th and early 20th centuries. These crises often resulted in widespread bank failures, economic downturns, and unemployment, highlighting the need for a more stable and reliable banking system. Guys, the my nose is acting up. Is it because of the climate? No, actually, it's not that cold. Like it's getting. I mean, the summer is starting. Not that summer, but like the winter is ending now, right? So it's a bit. It's not that cold in the morning and all. So I used to think that was the problem, but it's not. Okay. Several attempts have been made to address these issues, including the establishment of National Monetary Commission in 1907 to study the banking system and make recommendations for reform. This commission identified several problems with the existing system, including a lack of coordination among banks, insufficient reserves, and an adequate mechanism for responding to financial crises. In 1910, a group of influential bankers and financiers met in secret on Jekyll Island in Georgia to discuss the creation of central banking system that could address these issues. So this we discussed like in detail, like in the last chapter. Their efforts culminated in the drafting of a proposal that would eventually become the basis for the Federal Reserve Act of 1913. The motivation for creating Federal Reserve System was to provide a more stable and flexible banking system that could respond to the needs of the economy. By establishing a central bank with the power to regulate the money supply and serve as a lender of last resort. Okay, it's not a tongue twister, but I don't know. Sometimes I find it difficult to say it. Lender of last resort during financial crisis. The hope was that the system could prevent future economic downturns and promote long-term economic growth. The structure and organization of the Federal Reserve System. The Federal Reserve System is a central banking system that was created to provide stability and flexibility to the United States financial system. The system is composed of three key entities: the Board of Governors, the Federal Reserve Bank, the Federal Open Market Committee or FOMC. The Board of Governors is the main governing body of the Federal Reserve System, responsible for setting monetary policy and supervising the operations of the Federal Reserve banks. The board consists of seven members who are appointed by the President of the United States and confirmed by the Senate. The chair of the board is appointed by the President and serves as the chief executive officer of the Federal Reserve System. The Federal Reserve banks are the 12 regional banks that are responsible for implementing monetary policy and providing financial services to their respective regions. Each Federal Reserve Bank is overseen by a board of directors, which is composed of 9 members. Six of these directors are elected by member banks, while three are appointed by the Board of Governors. The Federal Open Market Committee or FOMC is responsible for conducting monetary policy in the United States. The FOMC is composed of 7 members of the Board of Governors and 5 of the 12 presidents of Federal Reserve banks on a rotating basis. The FOMC meets several times per year to discuss economic conditions and set monetary policy. Overall, the structure of the Federal Reserve System is designed to provide both centralized decision making and regional representation, allowing the system to respond to the needs of the US economy while maintaining stability and efficiency. The Federal Reserve System has a unique ownership structure that combines both private and public elements. The Fed is not owned by the federal government but is subject to oversight by Congress and ultimately accountable to the public. The Fed's ownership structure is composed of two main types of institutions: member banks and the Board of Governors. The Board of Governors is a public institution that is appointed by the President and confirmed by the Senate. The seven members of the Board of Governors serve staggered 14-year terms. Member banks are private commercial banks that hold stock in one of the 12 regional Federal Reserve banks. These regional banks are also private institutions with their own board of directors, but they are subject to oversight by the Board of Governors. Member banks are required to hold certain amount of stock in their regional Federal Reserve Bank based on their size and deposit. However, the ownership of the stock does not confer control over the Federal Reserve System or its policies. In theory, but in practice, that's a different matter which is not discussed in this book. Overall, while the Federal Reserve System is not fully government owned, its public private ownership structure allows for a degree of independence and flexibility in carrying out its monetary policy. Monetary policy responsibilities while also being accountable to the public and subject to congressional oversight. The functions and responsibilities of the Federal Reserve System. The Federal Reserve System has several important functions and responsibilities that are essential to the stability and health of the United States economy. Firstly, the Federal Reserve is responsible for conducting monetary policy in the United States. This means that it controls the money supply and interest rates with the goal of promoting full employment and stable prices. To achieve this goal, the Federal Reserve uses a variety of tools, including adjusting the funds rate, buying and selling government securities, and setting reserve requirements for banks. Secondly, Federal Reserve serves as a lender of last resort to banks and other financial institutions. This means that it provides emergency loans to banks that are experiencing financial distress, helping to prevent a broader financial crisis. Thirdly, Federal Reserve is responsible for supervising and regulating banks and other financial institutions to ensure their safety and soundness. This includes setting up capital requirements and conducting regular examinations of banks to ensure they are complying with regulations. Finally, the Federal Reserve also plays an important role in promoting the stability of the overall financial system. This includes monitoring financial markets and institutions for potential risks and taking actions to address systemic risks as necessary. Overall, the functions and responsibilities of the Federal Reserve are crucial to the health and stability of the US economy, and its actions can have a significant impact on financial markets and institutions both domestically and globally. Next, the role of the Federal Reserve Banks in the American banking system. The Federal Reserve System comprises 12 regional Federal Reserve Banks, which are independent institutions that operate under the supervision of the Board of Governors in Washington, D.C. Each of the 12 Federal Reserve Banks serves a particular geographic region of the United States and works closely with its member banks to implement monetary policy and provide various financial services. The Federal Reserve Banks play a crucial role in the American banking system, particularly in providing a range of services to depository institutions. These services include processing checks, distributing currency coins, and providing short term loans to banks in need of liquidity. In addition, Federal Reserve banks serve as a banker's bank, which means that they hold deposits and provide loans to depository institutions. They also supervise and regulate banks and other financial institutions within their respective districts. Furthermore, the Federal Reserve Bank act as a liaison between the government and the private sector by collecting and disseminating economic data and providing advice on economic and financial matters to policymakers. Burping. I mean, this always happens, right? Whenever I drink like black tea in empty stomach. Mm. They also play a critical role in implementing monetary policy by buying and selling government securities and adjusting the discount rate, which is the interest rate that banks pay to borrow money from Federal Reserve banks. Overall, the Federal Reserve banks are essential components of the American banking system, providing crucial services to depository institutions and serving as key players in implementing monetary policy and maintaining financial stability. The Federal Reserve's monetary policy tools. The Federal Reserve System has several monetary policy tools at its disposal to achieve its dual mandate of promoting price stability and maximum employment. These tools are used to influence the money supply and credit availability in the economy. Open market operations. The Federal Reserve conducts open market operations by buying and selling US Treasury securities in the open market. When the Fed buys these securities, it increases the reserves held by the banks, which in turn increases the money supply and lowers interest rates. Conversely, when the Fed sells these securities, it decreases the reserves held by banks, which decreases the money supply and raises interest rates. Discount rate. The discount rate is the interest rate at which banks can borrow money from the Federal Reserve. When the discount rate is lowered, it encourages banks to borrow more money, which increases the money supply and stimulates economic activity. Conversely, when the discount rate is raised, it discourages banks from borrowing money, which decreases the money supply and slows down economic activity. Reserve requirements. The Federal Reserve can also adjust the reserve requirement, which is the amount of money that banks are required to hold in reserves. When the reserve requirement is lowered, it frees up more money for banks to lend out, which increases the money supply and stimulates economic activity. Conversely, when the reserve requirement is raised, it restricts the amount of money banks have to lend out, which decreases the money supply and slows down economic activity. Overall, these monetary policy tools allow the Federal Reserve to adjust the money supply and interest rates in the economy to achieve its dual mandate of promoting price stability and maximum employment. The impact of the Federal Reserve System on American politics and government. The Federal Reserve System has had a significant impact on American politics and government since its creation in 1913. As an independent agency, the federal government, as an independent agency of the federal government, the Federal Reserve plays a key role in shaping the country's economic policies and has the power to influence monetary policy and interest rates. This influence has often made the Federal Reserve a target of political criticism. One notable example of Federal Reserve's impact on politics occurred during the Great Depression, when the Fed contractory monetary policy was blamed for worsening the economic crisis. This led to the this led to a shift in the government's approach to the Fed, with increased oversight and regulation to ensure that its actions aligned with the goals of economic stability and growth. In recent years, the Federal Reserve has played a key role in addressing economic challenges such as 2008 financial crisis. Its actions such as implementing quantitative easing and setting interest rates have drawn both praise and criticism from politicians and economists. The Federal Reserve impact on politics and government extends beyond the economic realm as well. Its leadership and policies can influence political debates and campaigns, with some politicians arguing for more or less intervention in the economy based on their views of the Fed's role. Overall, the Federal Reserve's role in American financial system has made it a significant player in the country's political and governmental landscape, with its policies and actions affecting the lives of millions of Americans. The evolution of the Federal Reserve System since its creation. The Federal Reserve System has evolved considerably since its creation in 1913. Initially, the Federal Reserve was designed to provide a stable banking system, control the money supply, and prevent bank runs. Over time, its role has expanded to including regulating banks and financial institutions, overseeing consumer protection laws, and promoting monetary policy objectives such as price stability and full employment. One of the most significant changes in the evolution of the Federal Reserve was the expansion of its powers during the Great Depression in the 1930s. The Federal Reserve played a critical role in stabilizing the banking system, providing liquidity, and promoting economic recovery. The Banking Act of 1935 gave the Federal Reserve the authority to regulate member banks' reserve requirements and supervise bank holding companies, further solidifying its role in the US financial system. Another significant shift occurred in 1970s when the Federal Reserve moved from a focus on fixed exchange rates to a floating exchange rate system. This change allowed for greater flexibility in monetary policy and provided greater stability in international financial markets. In the 21st century, the Federal Reserve has continued to evolve to meet the challenges of a rapidly changing financial landscape. The 2008 financial crisis led to significant reforms, including the Dodd-Frank Wall Street Reform and Consumer Protection Act, which expanded the Federal Reserve's oversight of financial institutions and strengthened consumer protections. As technology continues to transform the financial sector, the Federal Reserve has also embraced digital innovation. In recent years, the Federal Reserve has explored the potential for a central bank digital currency, which is CBDC, and other fintech applications to promote financial inclusion and stability. Overall, the Federal Reserve has undergone significant changes since its creation, and it will continue to evolve to meet the challenges of a constantly changing financial landscape. The contemporary debates around the role and function of Federal Reserve System. The Federal Reserve System has been a subject of debate and controversy since its creation. One ongoing debate concerns the proper role and function of the Federal Reserve System in the American economy. Some argue that the Fed should take a more active role in stabilizing economy and ensuring maximum employment, while others believe that the Fed should have a more limited role and focus primarily on controlling inflation. Another area of debate concerns the structure and accountability of Federal Reserve System. Some argue that the current structure with Board of Governors in Washington DC and regional Federal Reserve banks is too decentralized and lacks sufficient oversight. Others argue that the decentralized structure allows for a better representation of regional economic conditions and promotes financial stability. There is also debate about the independence of the Federal Reserve System. While the Fed is technically part of the government, it operates with a high degree of independence from political influence. Some argue that this independence is necessary to ensure the Fed can make decisions based on economic fundamentals rather than political considerations. Others argue that the Fed's independence can make it less accountable to the public and elected officials. Finally, there is debate about effectiveness of the Federal Reserve System. While the Fed has been successful in controlling inflation, some argue that it has not been as effective in achieving its other mandates, such as promoting maximum employment. Others argue that the Fed has been too aggressive in its use of monetary policy, which has led to economic instability and inequality. Overall, the debate around the role and function of Federal Reserve System is ongoing and reflects different views about the proper role of the government in the economy and balance between centralization and decentralization in economic policy making. So that was the chapter on the Fed and its provisions. Now we'll discuss the role of the Fed in business cycle. Chapter 15. First, we'll discuss the concept of business cycle and its phases. The business cycle is a recurring pattern of economic expansion and contraction that can be observed in all modern economies. It is characterized by four phases: expansion, peak, contraction, and trough. During the expansion phase, economic activity is increasing and employment, production, and consumption are all on the rise. As the economy approaches its peak, growth slows down, the economic activity starts to level off. This marks the beginning of a contraction phase. During this, during which economic activity slows down and the economy enters a recession. The trough is the point at which economic activity is at its lowest and the recession has bottomed out. At this point, the economy starts to recover, marking the beginning of the next expansion phase. The duration and intensity of each phase of business cycle can vary significantly from one cycle to another. Factors such as consumer spending, business investment, government spending, and external economic conditions can all influence the timing and severity of each phase. The concept of the business cycle is important for policymakers and economists to understand as it can help them anticipate and prepare for economic downturns and develop policies that can support economic growth during periods of expansion. The historical context of the Fed's role in business cycle. The historical context of the Federal Reserve's role in business cycle dates back to the Great Depression, which was the most severe economic downturn in the history of United States. The stock market crash of 1929 led to a sharp decline in economic activity, resulting in high levels of unemployment, bank failures, and deflation. In response to the economic crisis, President Franklin D. Roosevelt signed the Banking Act of 1933, which established the Federal Deposit Insurance Corporation or FDIC to insure bank deposits and Federal Open Market Committee FOMC to oversee the implementation of monetary policy. During the post World War II era, the Fed's role in business cycle evolved as it sought to promote economic stability and full employment. In 1950s and 1960s, the Fed pursued a policy of fine-tuning the economy through monetary policy adjustments. However, this approach came under the criticism in 1970s as the economy experienced both high inflation and high unemployment in what became known as stagflation. Yeah, guys, it's getting worse. The nose is getting worse. The Fed's monetary policy tools for managing the business cycle. Because I'll be back. Let me just go and wipe the nose, wash face, and I'll come back. I'm back. I'm back. Okay, where were we? Yeah, the Fed's monetary policy tools for managing the business cycle. The Federal Reserve System employs a variety of monetary policy tools to manage the business cycle, which is the fluctuation in economic activity that occurs over time. The primary tools used by the Fed to manage business cycle include open market operations, discount rate policy, and reserve requirements. Open market operations involve the buying and selling of government securities on the open market. When the Fed purchases government securities from banks, it increases the amount of reserves available to banks, which can then lend more money to consumers and businesses, thus stimulating economic growth. Conversely, when the Fed sells government securities to banks, it decreases in lending and economic growth. Discount rate policy refers to the interest rate at which banks can borrow from the Fed. When the Fed lowers the discount rate, it makes it cheaper for banks to borrow money, which can stimulate lending and economic growth. Conversely, when the Fed raises the discount rate, it makes it more expensive for banks to borrow money, which can slow down lending and economic growth. Reserve requirements refer to the percentage of deposits that banks are required to hold in reserve. When the Fed lowers reserve requirements, it frees up more money for banks to lend, which can stimulate economic growth. Conversely, when the Fed raises reserve requirements, it restricts the amount of money banks have available to lend, which can slow down economic growth. Overall, the Fed's monetary policy tools are designed to help manage the business cycle by controlling the supply of money and credit in the economy. The Fed's use of interest rates and reserve requirements in the business cycle. The Federal Reserve's main tool for managing the business cycle is the use of interest rates and reserve requirements. When the economy is growing too quickly and inflation is a concern, the Fed can raise interest rates and reserve requirements, which make it more expensive for banks to lend money and thus slow down economic growth. Conversely, when the economy is in a recession or experiencing slow growth, the Fed can lower interest rates and reserve requirements, which makes it cheaper for banks to lend money and thus stimulates economic activity. Interest rates are set by the Federal Open Market Committee or FOMC, which meets 8 times a year to review economic data and decide whether to adjust rates. The FOMC can either raise or lower the federal fund rate, which is the interest rates that banks charge each other for overnight loans. When the Fed raises the federal funds rate, it becomes more expensive for banks to borrow money, which can lead to higher borrowing costs for businesses and consumers. Conversely, when the Fed lowers the federal fund rate, it becomes cheaper for banks to borrow money, which can lead to lower borrowing costs for businesses and consumers. Reserve requirements refer to the amount of money that banks are required to hold in reserve in order to cover potential losses. The Fed can adjust reserve requirements as a way of managing the amount of money that banks have available to lend. When the Fed raises reserve requirements, banks have less money available to lend, which can slow down economic growth. Conversely, when the Fed lowers reserve requirements, the banks have more money available to lend, which can stimulate economic growth. The connection between the Fed's monetary policy and economic indicators. The Federal Reserve uses a variety of economic indicators to assess the state of the economy and make decisions regarding monetary policy. Some of the key indicators the Fed monitors include gross domestic product (GDP), inflation, employment and unemployment rates, consumer and business confidence, and the housing market. For example, the Fed may use GDP data to gauge the overall level of economic activity in the country. If the GDP growth is slow, the Fed may take steps to lower the interest rates to stimulate borrowing and spending, which can help boost economic activity. Conversely, if GDP growth is too rapid and inflationary pressures are building, the Fed may raise interest rates to cool down the economy. Similarly, the Fed looks at inflation data to assess the level of price increases in the economy. If inflation is running too high, the Fed may raise interest rates to slow down economic activity and cool off inflationary pressures. On the other hand, if inflation is running below the Fed's target level, the Fed may lower interest rates to encourage more spending and stimulate the economy. Overall, the Fed's monetary policy decisions are closely tied to these indicators, closely tied to these key economic indicators and their interpretation of them. The Fed uses this information to make informed decisions on interest rate policy and other monetary tools to achieve its dual mandate of promoting maximum employment and price stability. The impact of the Fed's monetary policy on inflation and employment. The Federal Reserve's monetary policy has a significant impact on inflation and employment in the United States. The Fed's primary goal is to maintain price stability and full employment, and it uses its monetary policy tools to achieve these objectives. When the Fed raises interest rates, it can slow down the economy by making it more expensive to borrow money. This can reduce inflationary pressures by decreasing demand for goods and services, which can lead to lower prices. However, it can also lead to a decrease in employment as businesses may be less likely to invest in growth and hire new employees. On the other hand, when the Fed lowers interest rates, it can stimulate economic growth by making it cheaper to borrow money. This can lead to an increase in employment as businesses are more likely to invest in growth and hire new employees. However, it can also lead to an increase in inflationary pressures as demand for goods and services increases, which can lead to higher prices. The Fed also has the ability to adjust reserve requirements for banks, which can impact the availability of credit in the economy. By increasing reserve requirements, the Fed can decrease the amount of credit available, which can help to curb inflation. However, this can also lead to a decrease in employment as businesses may have less access to credit for growth and investment. Overall, the Fed's monetary policy decisions have a significant impact on inflation and employment, and the Fed must carefully balance its goals of price stability and full employment when making policy decisions. The criticisms and controversies around the Fed's role in the business cycle. The Federal Reserve's role in managing the business cycle has been a subject of criticism and controversy since its inception. Some critics argue that the Fed's policies are too interventionist and interfere with the natural working of the market, while others argue that the Fed has not been aggressive enough in responding to economic downturns. One common criticism of the Fed's role in the business cycle is that its policies can lead to inflation as the expansion of the money supply can increase demand for goods and services, leading to higher prices. Some critics argue that the Fed should focus more on maintaining price stability and less on promoting economic growth. Others argue that the Fed's policies favor certain segments of the economy over others, such as large banks and corporations over small businesses and individuals. This has led to calls for greater transparency and accountability in the Fed's decision-making process. Some also argue that the Fed's policies have contributed to income inequality, as low interest rates can lead to higher asset prices, benefiting those who hold assets such as stocks and real estate, while leaving those without such assets behind. Overall, the Fed's role in managing the business cycle remains a subject of debate and controversy, with competing views on the appropriate balance between promoting economic growth and maintaining stability. The role of the Fed in management of Great Recession. The Great Recession of 2008-2009 was one of the most severe economic crises in US history, and the Federal Reserve played a crucial role in managing it. As the recession began to unfold, the Fed took a number of extraordinary steps to try to stabilize the economy and prevent a complete collapse. One of the Fed's primary tools during the crisis was monetary policy, which it used to stimulate the economic growth and prevent deflation. The Fed lowered the interest rates to near zero levels, and it also implemented a program of quantitative easing in which it purchased large amounts of government and mortgage backed securities in order to inject liquidity into the financial system. I'm getting a sneeze. The Fed also worked closely with other policymakers, including the Treasury Department and Congress, to try to stabilize the banking system and prevent a complete collapse of the financial sector. The Fed provided emergency loans to banks and other financial institutions, and it also implemented stress tests to determine which banks were most at risk of failure. Overall, the Fed's actions during the Great Recession were generally seen as successful in preventing a complete economic collapse, although they were not without controversy. Some critics argued that the Fed's policies were too aggressive and could lead to inflation and other economic problems in the future. Nonetheless, the Fed's role in managing crisis highlighted its important role as a key player in the US economic policy. The impact of the Fed's policies on the current state of the American economy. The Fed's policies have had a significant impact in the current state of the American economy. Since the Great Recession of 2008, the Fed has taken several measures to stimulate economic growth and stabilize financial markets. One of the key actions taken by the Fed was to lower interest rates to near zero levels, making borrowing cheaper and encouraging consumer and business spending. Additionally, the Fed implemented several rounds of quantitative easing, which involved purchasing large amounts of government bonds and mortgage backed securities to inject liquidity into the financial system and stimulate lending. These policies have helped to support economic growth, create jobs, and boost asset prices such as stocks and real estate. However, they have also led to some unintended consequences. One of the biggest concerns is the potential for inflation, as the Fed's actions have increased the money supply and lowered interest rates, which can lead to higher prices. Additionally, some experts argue that the Fed's policy have contributed to income inequality, as the benefits of rising asset prices are disproportionately enjoyed by wealthier individuals and institutions. Overall, the impact of the Fed's policies on the American economy is a topic of ongoing debate and analysis among policymakers, economists, and the public. Ah, shit. Guys, I'm dying. I'm dying. My nose is clogging up. Why today, right? No, the I we have discussed about the glasses, but I told you, right, putting glasses it will be difficult to read. That's the only reason. I can I can turn off the lights, but then the stream won't look nice. Compromises, huh? The future of the Fed's role in the business cycle and its implications. The future of the Federal Reserve's role in the business cycle remains uncertain as it faces several challenges and potential changes. one of the biggest challenges in the unprecedented economic and financial impact of COVID-19 pandemic, which has forced the Fed to take unprecedented measures such as massive asset purchases and cutting interest rates to near zero to support the economy and financial markets. In addition to the pandemic, the Fed faces challenge of a potentially changing political and regulatory environment. The Trump administration had sought to limit the Fed's independence and weaken its regulatory powers, while Biden administration has signaled a desire to strengthen the Fed's role in promoting full employment and addressing inequality. This was actually during the pandemic, so that's why this topic is there. Another potential change is the Fed's ongoing review of its monetary policy framework, which could result in a shift towards a more aggressive inflation target or other changes in its policy tools and communication strategy. The implications of these challenges and potential changes are significant for the economy and financial markets, as the Fed's actions can have far reaching effects on inflation, employment, and asset prices. The future role of the Fed in the business cycle will likely be shaped by these and other factors and will require careful consideration and adaptations to effectively manage the economy and financial system. Okay, so now we understood the Fed's role in business cycle and what business cycle like on a this was not that technical, right? The other book I think I mentioned, yeah, we'll discuss it further with the technical terms and theory. Now, chapter 16, the crash of 1907 and JP Morgan's role. The historical context of the Panic of 1907. The Panic of 1907 was a financial crisis that occurred in the United States in October 1907. It was one of the worst financial crises in American history and had a significant impact on the economy. The panic was triggered by a series of events, including the collapse of a Knickerbocker Trust Company, which was one of the largest trust companies in the country. The collapse of the Knickerbocker Trust Company caused a panic among investors who began to withdraw their funds from other banks and trust companies. The panic was exacerbated by a number of other factors, including the speculative bubble in the stock market, the failure of several other banks and trusts, and the scarcity of gold reserves in the country. The panic led to a severe contraction of credit, which had a ripple effect on the broader economy, causing businesses to fail and unemployment to rise. The Panic of 1907 occurred during a time of rapid industrialization and economic growth in the United States, but it also reflected many of the underlying weaknesses and vulnerabilities of American financial system. It highlighted the need for reforms and regulations to stabilize the banking system and prevent future financial crises. The panic played a crucial role in the creation of the Federal Reserve System, which was established in 1913 to provide a more stable and secure banking system in the United States. The causes of the Panic of 1907. The Panic of 1907 was triggered by a series of events that weakened the American economy, leading to a widespread loss of confidence in the banking system. The root cause of the panic was the over expansion of credit and speculation in the stock market, which created a bubble that eventually burst. Another contributing factor was the emergence of trust companies, which were unregulated and engaged in risky investment practices, including lending of companies with insufficient collateral. The failure of one such trust, the Knickerbocker Trust, sparked a run on other trust companies and banks, leading to widespread bank failures. The panic was also exacerbated by a shortage of currency, as banks held onto their reserves in response to the crisis, leading to a liquidity crunch. The failure of several large banks and trust companies caused the domino effect, spreading panic and uncertainty throughout the financial system. Finally, the panic was exacerbated by a lack of effective leadership from the government, which failed to intervene in a timely and effective manner. Without a central bank and other regulatory authority to coordinate a response, the crisis deepened and spread, ultimately resulting in a severe recession. The role of JP Morgan in managing the panic of 1907. The panic of 1907 was a severe financial crisis that shook the American economy. During this time, JP Morgan played a crucial role in managing the crisis and stabilizing the financial system. Morgan was a prominent banker and financier who was respected and trusted by many in the financial community. When the crisis hit, Morgan used his influence and resources to coordinate a response among leading bankers and financial institutions. Morgan assembled a group of leading bankers in his library and worked tirelessly to develop a plan to stabilize the financial system. He convinced banks to loan money to each other to increase liquidity, thereby preventing further bank failures. Morgan himself personally lent millions of dollars to struggling banks and corporations to keep them afloat. Morgan's efforts were critical in preventing the crisis from spiraling out of control. His ability to bring together key players in the financial community and mobilize them to take action was instrumental in restoring confidence in the banking system. Morgan's role in the crisis was not without controversy, however. Some criticized his concentration of power and influence in the financial system, while others saw his actions as a form of private intervention in the economy. Nevertheless, Morgan's leadership during the crisis earned him the respect and admiration of many of the financial community and cemented his reputation as a financial titan. I'm dying. The actions taken by JP Morgan and other bankers to stabilize the banking system. During the panic of 1907, JP Morgan and other bankers took several actions to stabilize the banking system and prevent a total collapse of the economy. One of the first steps was the creation of the Morgan Consortium, a group of bankers led by JP Morgan who pledged their own money to inject liquidity into the financial system. The consortium, is it consortium or consortium? Consortium, right? CONSORTIUM. The consortium helped to prevent the collapse of several major banks, including the Knickerbocker Trust Company, which had sparked the initial panic. In addition to the Morgan Consortium, JP Morgan himself played a key role in organizing the bailout of several major corporations, including the United Copper Company and Tennessee Coal, Iron, and Railroad Company. Morgan's actions helped to restore confidence in the market and prevent further panic. Other actions taken by bankers, including increasing their own lending to other banks and issuing emergency loans to struggling companies. The New York Clearinghouse Association also played a critical role in providing liquidity to banks through the issuance of clearinghouse certificates. Overall, the actions taken by JP Morgan and other bankers helped to stabilize the financial system and prevent a total collapse of the economy. However, the panic exposed weaknesses in the banking system and ultimately led to the creation of the Federal Reserve System in 1913. The political and economic consequences of the Panic of 1907. The Panic of 1907 had significant political and economic consequences. The crisis caused widespread panic and bank runs, which resulted in many bank failures and economic disruption. As a result, the US economy entered into a severe recession with unemployment rates rising and industrial production declining. In response, the US government took several measures to address the crisis. One significant political consequence of the Panic of 1907 was the establishment of the Federal Reserve System. The crisis highlighted the need for a more centralized and flexible banking system that could provide liquidity during times of economic stress. The Federal Reserve Act of 1913 created the Federal Reserve System, which gave the government the ability to regulate the money supply and stabilize the banking system. Economically, the panic of 1907 led to the decline of several industries, particularly railroads, which were heavily impacted by the crisis. Many smaller banks also failed, leading to consolidation in banking sector. In addition, the crisis highlighted the need for increased government regulation of the financial system to prevent future crises. Overall, the panic of 1907 had a significant impact in the US economy and led to the establishment of new policies and regulations aimed at preventing similar crises in the future. Next, the legacy of JP Morgan's role in the panic of 1907. The legacy of JP Morgan's role in the panic of 1907 was profound, as he became known as the savior of the American financial system. Morgan's actions during the panic demonstrated the power and influence of private individuals over the financial system. Morgan's ability to bring together the major banks and trusts of the era to provide liquidity to the system was unprecedented and solidified his reputation as the most powerful banker in America. Morgan's role in the Panic of 1907 also had lasting impacts on the relationship between government and private sector. Many Americans viewed Morgan's actions as a necessary intervention in the absence of government action. But others criticized his influence over the financial system and called for greater government regulation of the banking industry. Furthermore, Morgan's actions helped to set the stage for the creation of the Federal Reserve System, which was established in 1913 to provide a more stable and centralized system of monetary policy. The Panic of 1907 served as a catalyst for the creation of the Fed as policymakers recognized the need for a more coordinated response of financial crisis. Overall, JP Morgan's role in the Panic of 1907 had a lasting impact on the American financial system and helped to shape the role of private individuals and government in the management of the financial crisis. The connection between the Panic of 1907 and the creation of the Federal Reserve System. The Panic of 1907 was a significant event in the history of United States that led to the creation of the Federal Reserve System. The crisis highlighted the weakness in the country's banking and financial systems, and it became clear that the nation needed a more robust and centralized system to prevent future panics. JP Morgan's role in managing the crisis was crucial, but it also highlighted the concentration of financial power in the hands of a few individuals. This fact raised concerns about the dangers of private control over the nation's money supply, prompting calls for a more democratic and government led approach to the monetary policy. The Panic of 1907 also exposed the inadequacy of the existing mechanisms for providing liquidity to banks during times of crisis. The government's response to the panic was to rely on ad hoc solutions such as creation of the National Monetary Policy and the Aldrich Vreeland Agreement. not agreement, act, Aldrich Vreeland Act. But these measures were deemed insufficient. These issues eventually led to the creation of the Federal Reserve System in 1913. The Fed was designed to be a more centralized and government led institution that could provide stability to the nation's banking and financial systems. Its mandate included the regulation of banks, the management of the money supply, and prevention of future panics. Overall, the Panic of 1907 played a pivotal role in the creation of the Federal Reserve System, which has been an essential institution in the American economy ever since. The impact of Panic of 1907 on American banking and finance. The Panic of 1907 had a significant impact in the American banking and finance. The panic exposed the weaknesses in the country's banking system and highlighted the need for a more centralized approach to monetary policy. As a result, there was a growing demand for the establishment of a central bank that could act as a lender of last resort and stabilize the financial system during times of crisis. In the aftermath of the panic, many banks failed and there was a shortage of liquidity in the system, which led to the contraction of credit. This contraction led to a slowdown in economic activity, with businesses struggling to obtain the funds they needed to operate. The panic also led to a decline in confidence in the banking system and a loss of trust in the ability of banks to safeguard people's savings. The Panic of 1907 was one of the reasons that the Federal Reserve System was established in 1913. The Fed was designed to provide a more stable and secure banking system and to prevent future panics and financial crises. It established a framework for a centralized approach to monetary policy and gave the government the tools it needed to stabilize the economy during times of crisis. The Fed's establishment also led to the creation of a more efficient payment system, which reduced the risk of bank failures and increased the availability of credit. The lessons learned from the Panic of 1907 and the relevance today. The Panic of 1907 was a significant in the lasting effects of uh, event that had lasting effects on American banking and finance. One of the key lessons learned from the crisis was the need for a more centralized and coordinated response to financial emergencies. The actions taken by JP Morgan and other bankers were ad hoc and relied on the personal relationships and resources of individuals rather than a systemic approach. This highlighted the need for a more structured and formalized system of financial regulation and crisis management. The Panic of 1907 also demonstrated the importance of liquidity and the role of the lender of last resort in times of crisis. The actions of JP Morgan and other bankers helped to inject liquidity into the system, but the lack of a formalized system for providing emergency liquidity meant that it was largely reliant on the personal resources of individuals. This highlighted the need for a more formalized system for providing liquidity during times of crisis, which was a key feature of the Federal Reserve System created in 1913. Today, the lessons learned from the Panic of 1907 remain relevant. The importance of a coordinated response to financial crisis and the role of the lender of last resort are still key features of modern financial systems. The lessons learned from the Panic of 1907 also highlight the importance of financial regulation and oversight to prevent and mitigate financial crises. The repercussions of Panic of 1907 on the global financial system. The Panic of 1907 had significant repercussions on global financial system, particularly in Europe. The interconnectedness of financial institutions across the Atlantic meant that the panic led quickly and many European banks suffered significant losses. The crisis led to a sharp decline in the value of pound sterling and a rise in interest rates which had a profound impact on the global economy. One of the key repercussions of the panic was the increased demand for gold. As investors fled to safety, they sought refuge in gold, which was seen as a safe haven asset. This caused a significant strain on the global gold supply, leading to a shortage of gold reserves in many countries, particularly in Europe. This shortage of gold had a lasting impact on the global monetary system and led to changes in the way that central banks manage their reserves. Another repercussion of the panic was the increased scrutiny of the financial institutions and the need for stronger regulatory oversight. The lack of effective regulation was seen as a significant factor in the panic, and there was a growing recognition of the need for stronger oversight and regulation of financial markets. This led to the creation of new regulatory bodies and increased government intervention in financial markets. Overall, the panic of 1907 highlighted the interconnectedness of global financial system and the need for effective regulation and oversight. The lessons learned from the panic continue to be relevant today as policymakers seek to manage financial crisis and ensure stability of the global financial system. Next is Chapter 17, World War One and Financing of All Sides. The historical context of World War One and its financing. World War One, also known as the Great War, was a global conflict that lasted from 1914 to 1918. The war involved major powers from around the world, including Germany, Austria Hungary, the Ottoman Empire, and the United States. The causes of the war were complex and included factors such as imperialism, nationalism, and the formation of military alliances. Financing the war was a major challenge for all sides. Governments had to find ways to raise large amounts of money to fund war effort, which involved massive expenditures on weapons, supplies, and troops. The financing of the war was largely done through borrowing from both domestic and international sources, including banks and financial institutions. Governments also raised funds through taxes and the sale of the bonds and war savings certificates. The financing of the war had a significant impact on the global financial system. The scale of the borrowing required to finance the war led to the creation of new financial instruments and institutions. It also led to the expansion of central banking and creation of the Federal Reserve in the United States. The war also contributed to the growth of inflation and debt in many countries. The economic consequences of the war continued to be felt long after it had ended. The role of banks and financial institutions in financing the war effort. The role of banks and financial institutions in financing World War One was crucial as it required a significant amount of funding. The governments of participating countries needed to raise massive amounts of money to cover the cost of the war, such as buying arms, ammunition, and other necessary resources. Banks and financial institutions played a vital role in the war financing by facilitating the issuance of government bonds and providing loans to the governments. The government relied on these banks and financial institutions to raise the funds they needed for the war effort. In many cases, banks and financial institutions also purchased government bonds to support the war effort. In addition to supporting the war through direct funding, banks and financial institutions also played a role in managing the economies of the countries involved in the war. They helped stabilize the currency values and manage inflation by supporting their respective central banks. Overall, banks and financial institutions played a critical role in financing World War One. Without their support, it would have been challenging for the participating countries to fund the war effort, and the outcome of the war might have been different. However, this support also came at a cost as the economic consequences of the war impacted the global financial system for years to come. Hey Castaways, what's up, man? I didn't see the message. When do you think your next stream will be? No, tomorrow, bro. Tomorrow, same time. Yeah. What's up, man? Why? Why did you ask? No, like gaming stream. Yeah, I don't know, man, about gaming stream. I don't know. We'll see. Maybe after finishing this book, we'll do like a, I don't know what game. I don't even want to do a gaming stream because I don't want to play any game. Gino has turned a new leaf. Now, because I told you, right? Uh, reason I started streaming in the first place was like I haven't played Minecraft in a long time, and I was like, okay, I just want to play it, but I don't want to simply play the game, so I started streaming. And now I don't want to play any games. You got the point, right? Yeah, I started streaming because I wanted to play games, and I stopped streaming because I didn't want to play game. And now I am streaming because I wanted to read the book. So maybe, bro, maybe in the future, I don't know. Yeah, what else, man? You, house life. For you, maybe we'll do a gaming stream after this book, or maybe after the next book. I'll let you know. I'll let you know in the Discord whenever we plan a gaming stream. Fine. Okay. So the next subtopic: the use of bonds, loans, and taxes to fund the war. The use of bonds, loans, and taxes was a critical component of the financing of World War One. Governments on all sides of the conflict sought to raise vast sums of money to pay for the war effort, and bonds, loans, and taxes were the primary tools they used to do so. Governments initially turned to bond issues to raise the vast sums of money needed for the war. Bonds were issued to the public with interest rates varying based on the perceived risk associated with the issuing government. Bonds were marketed to the public using patriotic appeals, with governments urging their citizens to support the war effort by purchasing bonds. In addition to bonds, governments also turned to loans from banks, financial institutions to raise funds for the war effort. Taxes were also a crucial source of revenue for governments during the war. Governments increased taxes on everything from income to luxury goods to fund the war effort. These tax increases were often unpopular, and many people evaded or avoided paying them. In all, the use of bonds, loans, and taxes helped the governments to raise the vast sums of money needed to finance the war. However, it also resulted in a massive increase in public debt, which had long term consequences for the economies of many nations. Impact of the war on global financial system. World War One had a profound impact on the global financial system. The war caused the suspension of gold standard and led to the collapse of international financial system, which had been based on fixed exchange rates. The warring nations had to borrow heavily from banks and financial institutions to finance the war, and this resulted in an unprecedented level of government debt. To finance the war, the governments resorted to printing more currency, which led to inflation and devaluation of currencies. The war also caused disruptions in global trade, leading to a decline in economic growth and increased unemployment. The economic impact of the war was felt for years after its end, with many countries struggling to rebuild their economies. The war also had a significant impact on the banking industry. Many banks provided loans to governments to finance the war, which led to an increase in their profits. However, the war also exposed the vulnerabilities of the banking system, especially in times of crisis. Many banks failed due to the strain of the war and the loss of international trade. Overall, World War One had far reaching consequences for the global financial system, leading to a restructuring of the international monetary system and the establishment of new institutions like International Monetary Fund (IMF) and the World Bank. The role of the Federal Reserve in financing the war. During World War I, the Federal Reserve played a significant role in financing the war. As the central bank of the United States, the Federal Reserve was responsible for managing the country's money supply and ensuring the credit was available to fund the war effort. To finance the war, Federal Reserve was given the authority to issue government securities, including Liberty bonds, which were sold to the public to raise money for the war effort. The Federal Reserve also provided loans to banks and other financial institutions to support the war effort. In addition, Federal Reserve played a key role in stabilizing the economy during the war. The increased demand for goods and services during the war led to inflation, and the Federal Reserve used various tools such as open market operations to manage the money supply and control inflation. The Federal Reserve's role in financing the war and managing the economy during the war helped to strengthen its position as a central bank and demonstrated the importance of having a central bank to manage the country's monetary policy during times of crisis. The role of the gold standard in financing the war. During World War I, the gold standard was the dominant international monetary system. Under this system, countries maintained the convertibility of their currencies into gold at a fixed rate. The gold standard was seen as a guarantee of financial stability and a mechanism to prevent inflation. However, the war severely tested the gold standard's ability to provide stability in times of crisis. As countries began to mobilize for war, they experienced a significant drain on their gold reserves as they imported arms and munitions and other war related goods. To finance these purchases, countries resorted to borrowing from abroad, which increased their external debt. In addition, countries resorted to printing more money, which caused inflation to rise. The gold standard also created a problem for countries that needed to finance their war effort but did not have sufficient gold reserves. These countries had to either borrow from other countries, which created debt and increased their dependence on their creditors, or devalue their currency, which increased the cost of imported goods. In response to the strains on the gold standard caused by the war, countries began to abandon it, starting with Russia in 1914 and followed by many other countries in the years that followed. The gold standard was eventually suspended during the war and was not fully restored until the 1920s. The war and its aftermath revealed the limitations of the gold standard as a mechanism for providing financial stability in times of crisis. The economic consequences of the war on Europe and the United States. World War I had a significant impact on the economies of Europe and the United States. The war created a massive demand for war supplies and military personnel, leading to a boom in manufacturing and employment. However, the war also had negative consequences, including inflation, increased government debt, and a shift towards centralized planning and control of the economy. In Europe, the war devastated much of the infrastructure and industry, resulting in a significant economic downturn. Many European countries financed their war efforts through borrowing leading to high levels of debt and inflation. Germany in particular suffered from hyperinflation after the war, which severely damaged its economy and contributed to the rise of National Socialist Party. In the United States, the war helped to propel the country into a position of global economic power. The US government financed the war primarily through borrowing and sale of war bonds, which resulted in increased debt but also stimulated economic growth. The war also provided a boost to American industry and agriculture as the country supplied food and materials to the Allies. However, the post war period also saw economic challenges, including a recession and a brief period of inflation. The shift toward centralized economic planning during the war paved the way for increased government intervention in the economy in the following decades. The Treaty of Versailles and its financial consequences. The Treaty of Versailles, signed in 1919, officially ended World War I and established the terms of peace between the Allied powers and Germany. One of the key provisions of the treaty was the requirement for Germany to pay substantial reparations to the Allied powers to compensate for the damage and losses suffered during the war. The amount of reparations was initially set to 226 billion gold marks, which was later reduced to 132 billion gold marks. Germany was required to pay the reparations in annual installments, which had a significant impact on the country's economy. The German government had to print money to make payments, which led to hyperinflation and economic stability in the country. This economic instability helped to contribute to the rise of Adolf Hitler and the Nazi Party in Germany. The reparations also had an impact on the economies of the Allied powers. The Allied countries were counting on the reparations to help pay for their war debts. The failure of Germany to make timely payments led to financial crisis in France and Britain. The economic consequences of the Treaty of Versailles continued to be felt for decades as Germany struggled to pay the reparations and Allied countries dealt with the aftermath of the war. The lessons learned from World War I and its financing. World War I was a significant turning point in world history, including the global economy. The financing of the war effort taught many lessons which continue to be relevant today. One of the major lessons learned was the importance of government regulation and control of financial institutions during times of war. The war highlighted the dangers of unregulated financial systems, and governments began to implement measures to prevent future financial crises. Another lesson learned from World War I was the importance of economic stability for the success of countries' war efforts. Countries with weak economies, such as Germany, struggled to finance their war efforts, while countries with strong economies, such as the United States, were able to support the war for longer periods. The war also showed the importance of international cooperation and diplomacy in managing global financial systems. The Treaty of Versailles and resulting economic sanctions on Germany showed the world that punishment could have long term consequences and highlighted the need for a coordinated international response to economic issues. Additionally, the war led to the rise of a Keynesian economics. Keynesian economics, it's a theory. We'll discuss further. So this is like a economic theory. We'll discuss about that further in the next book. There are like two different things: Keynesian theory and Austrian theories. Additionally, the war led to the rise of Keynesian economics, which emphasized the government intervention in the economy during times of crisis. The government's role in financing the war effort led to an acceptance of increased government involvement in the economy and a shift away from laissez-faire economic policies, which is like free economy, free market economy, laissez-faire. The spelling is Laissezfaire. Overall, World War I taught many important lessons about the role of government in financial systems, the importance of economic stability during times of war, the need for international cooperation, and the value of government intervention in the economy during times of crisis. These lessons continue to be relevant today. The relevance of World War I's financing on modern warfare and international relations. The financing of World War I had a profound impact on the modern world and continues to influence modern warfare and international relations. The massive debt incurred by many nations during the war led to economic instability and created a need for financial reforms. The use of war bonds and other methods to finance the war also had a significant impact on public opinion and national unity. Governments used propaganda and patriotic appeals to encourage citizens to purchase war bonds, creating a sense of shared sacrifice and national purpose. The aftermath of World War I also laid the groundwork for the rise of totalitarian regimes and the destabilization of international relations. The harsh terms of the Treaty of Versailles imposed heavy financial reparations on Germany, leading to resentment and economic turmoil that contributed to the rise of Nazi Germany and the outbreak of World War II. Furthermore, the use of financial instruments as a tool of war has continued in modern times. Countries continue to use economic sanctions and other financial measures to pressure other nations and advance their interests. The global financial system has also been increasingly interconnected, making economic stability and cooperation vital to maintaining international peace and security. Overall, financing of World War I had far reaching consequences that continue to shape modern warfare and international relations. Next is chapter 18, the Contraction Act and Monopoly of Bankers. Now we'll take a small break, then we'll continue. Okay, the book is almost like at 75%. Yeah, this is like a relatively small book, right? Okay, 18 is Contraction Act and Monetary, the Monopoly of Bankers. Then is the Coinage Act of 1870 and Free Silver. So we are again going back to further discuss uh, the fiat system and the gold reserve system. The American Bankers Association and William Jennings Bryan. Then the Woodrow Wilson and the Income Tax Bill, the Federal Reserve and the business cycle, the evolving role of central banks, and alternative monetary systems. So this book ends with alternative monetary system, and the currency conundrum begins with that. Not alternative, yeah. We further discuss into the alternative monetary systems and their examples and the theories behind it and all. Yeah. Yeah. I'll be back, guys. I'll take a small break. Oh wait, even after alternative monetary system, there's another one: the future of financial power and its impact on society. That's the last chapter. Now we are going to discuss the Contraction Act. Contraction Act and the monopoly of bankers. Bankers. Okay, the Contraction Act and the monopoly of the bankers. The historical context of the Contraction Act and its significance. The Contraction Act, also known as the Resumption Act, was a US federal law passed by the Congress on January 14, 1875. The act was significant because it ended the use of paper money or greenbacks and required the government to redeem all paper currency in gold. This was controversial move as many believed it would result in deflation and economic recession. The Contraction Act was passed in the aftermath of the Civil War, during which the government had issued large amounts of paper currency to finance the war effort. This had led to inflation and devaluation of the currency. The act was intended to stabilize the currency by returning it to gold standard, which would in turn reduce inflation and restore confidence in the financial system. The Contraction Act also had political significance as it was part of the Republican Party's platform to reduce government spending and limit the power of the federal government. The act was strongly supported by President Ul- Ulysses S. Grant. Ulysses S. Grant, who believed it was necessary to restore fiscal responsibility of the government. The Contraction Act had significant implications for the US financial system and the economy, and its impact is still debated today. Some argue that it helped stabilize the currency and also restore confidence in the US financial system, while others believe it contributed to a deflationary spiral and economic recession. Regardless of its impact, the Contraction Act remains an important moment in the history of the US monetary policy. The purpose and provisions of the Contraction Act. The Contraction Act, officially known as the Act to amend the national banking laws and to provide the resumption of specie payments, was passed by the United States Congress in 1866. The primary purpose of the act was to reduce the amount of paper currency in circulation and return to the gold standard. This was a response to the inflationary pressures caused by the Civil War and the issuance of large amounts of paper currency by the federal government to finance the war. The Contraction Act authorized the Secretary of the Treasury to retire up to 10 million of greenbacks, the paper currency issued during the war, each month, and with the ultimate goal of reducing the outstanding amount of greenbacks to 300 million. The act also required the national banks maintain a minimum reserve of 25% in specie, gold or silver coin, against their outstanding notes. The act was controversial as it was seen as a potentially destabilizing the economy by reducing the amount of currency in circulation and potentially causing deflation. However, supporters of the act argued that it was necessary to restore confidence in the currency and stabilize the economy in the long run. Overall, the Contraction Act was an important piece of legislation that helped to shape the US financial system and establish the gold standard as the basis for US currency for many years to come. The impact of the Contraction Act on the economy. The Contraction Act, passed in 1866, had a significant impact on the US economy. The act required the US Treasury to retire 10 million in greenbacks, paper money issued during the Civil War, every month to maintain gold reserve equal to one third of its paper currency. The act was primarily designed to reduce inflation and stabilize the currency. However, the act had unintended consequences. The reduction in the money supply caused a contraction in the economy, leading to deflation, falling prices, and rise in unemployment. The act also had a negative impact on farmers and debtors who were struggling to repay loans. With the decrease in the money supply, borrowers found it harder to obtain credit and many businesses were forced to shut down. The contraction of the money supply led to a prolonged period of economic depression in the late 1860s and early 1870s, which affected the entire US economy. The Contraction Act also created a demand for gold, which led to a drain of gold from US, making it harder for US to maintain the gold standard. Overall, the Contraction Act had a significant impact on the US economy, causing a contraction and a prolonged period of economic depression. The act highlights the need for careful consideration of monetary policy decisions and the importance of balancing inflation and economic growth. The role of bankers in the Contraction Act. The Contraction Act of 1866 was passed during a time of great economic turmoil in the United States, with many banks failing due to over speculation and lack of central banking system. The act was primarily pushed by bankers and their allies in Congress who believed that the money supply needed to be tightened in order to restore confidence in the banking system and prevent inflation. Bankers played a significant role in the drafting and lobbying for the Contraction Act. They believed that the expansion of the money supply during and after Civil War had led to rampant inflation, which had hurt their ability to profit and lend credence to call for a central bank. They saw the Contraction Act as a way to stabilize the currency and make banking more profitable for themselves. However, the act ended up causing significant harm to the economy, especially to farmers and small businesses. The reduction of the money supply led to a deflationary spiral, causing prices to fall and making it harder for farmers and businesses to pay off their debts. This in turn led to a wave of bank failures, further exacerbating the economic downturn. Despite the negative impact of the Contraction Act, bankers were able to use their influence to maintain their power in the financial system. The act ultimately paved the way for a creation of a central banking system in the form of Federal Reserve, which bankers were able to shape to their advantage. Criticism and opposition of the Contraction Act. The Contraction Act faced significant criticism and opposition, particularly from farmers and small business owners who felt its effects more acutely. These groups argued that the act contributed to a deflationary spiral that worsened the economic downturn and disproportionately hurt those with less financial power. They also criticized the role of bankers in the act, accusing them of using their influence to promote their own interests at the expense of the broader economy. Opposition to the Contraction Act was not limited to these groups, however. Some economists and policymakers also questioned the Act's effectiveness and warned of its potential to exacerbate the economic crisis. For example, some argued that reducing the money supply at a time of economic contraction could deepen the downturn and prolong the recovery. Others criticized the act for its focus on monetary policy to the exclusion of other policy options such as fiscal stimulus or debt relief. Despite these criticisms, the Contraction Act remained in effect for several years, contributing to a prolonged period of deflation and economic stagnation. Its legacy continues to be debated among the economists and policymakers today, with some arguing that its contractionary policies worsened the Great Depression, while others see it as a necessary step toward sound monetary policy and central banking. The long term effects of the Contraction Act on the US financial system. The Contraction Act of 1866 had significant long term effects on the US financial system. By mandating the reduction of greenbacks in gold, it effectively tied the country's currency to the gold standard, a policy that remained in place until 1930s. This had the effect of stabilizing the US currency and making it more attractive to international investors, which in turn helped to strengthen the country's position as a global economic power. The act also had the effect of consolidating the power of private banks, as it allowed them to control the flow of gold and therefore exert greater influence over the economy. This concentration of financial power in the hands of a few bankers led to concerns about the potential for monopolistic practices and sparked debates about the need for greater government regulation of the banking industry. Furthermore, the act contributed to the development of central banking in the United States as it laid the groundwork for the creation of the Federal Reserve System nearly 50 years later. The Federal Reserve Act of 1913 was in part a response to the perceived need for a more stable and flexible monetary system that could better respond to economic shocks and maintain financial stability. Overall, the Contraction Act of 1866 had a profound impact on the US financial system and played a significant role in shaping the country's economic development in the decades that followed. The connection between the Contraction Act and central banking. The Contraction Act of 1866, considered by many scholars as a precursor to the establishment of the central bank in the United States. The act authorized the Treasury Department to retire up to 10 million in the greenbacks each month, which represented a significant contraction in the money supply. This move was seen as necessary to reduce inflation, which had been caused in part by the financing of the Civil War. The contraction of the money supply led to a severe recession that lasted until 1869, with many businesses failing, unemployment rates rising, and the commodity prices plummeting. The financial crisis caused by the Contraction Act highlighted the need for a more stable and predictable monetary system, which would be more effectively managed by a central bank. The debate over the establishment of a central bank continued for several decades after the Contraction Act, which, with proponents arguing that a central bank could help stabilize the economy and prevent financial crises, like the one caused by the Contraction Act. It was not until the Federal Reserve Act of 1913 that a central bank, the Federal Reserve System, was finally established in the United States. In this sense, Contraction Act can be seen as a pivotal moment in history of central banking in United States. The act highlighted the need for a more stable and predictable monetary system and provided the impetus for eventual establishment of a central bank. The lessons learned from the Contraction Act and its relevance today. The Contraction Act of 1866 taught a crucial lesson in the regulation of banking industry. It demonstrated the dangers of allowing private bankers to control the supply of currency and the importance of central bank intervention in times of financial crisis. The act revealed the power of banking industry in the political process and highlighted the need for strong government regulation to ensure financial stability. One of the most significant lessons learned from the Contraction Act is the importance of maintaining a stable money supply. The act led to a severe deflationary spiral, causing a contraction in the money supply and ultimately a deep economic depression. This highlighted the need for a central bank to manage the money supply and act as a lender of last resort to prevent such a crisis. Additionally, the Contraction Act demonstrated the influence of the banking industry in the political process. The opposition of the act from bankers and supporters highlighted the power of the financial sector in shaping government policy. It showed the need for political leaders to balance the interests of the financial industry with the need of the broader economy and society as a whole. Overall, the Contraction Act served as a cautionary tale of dangers of unregulated banking, and its lessons remain relevant today. It underscores the importance of strong government regulation and the need for central bank intervention to ensure financial stability in times of crisis. The debate on central banking and its influence on government policies. Central banking Central banking has been a topic of intense debate for many years, particularly in the United States. Those in favor of central banking argue that it provides a stable financial system and helps regulate the economy through monetary policy. On the other hand, opponents of central banking argue that it leads to government control and manipulation of the financial system and that it is unnecessary and ineffective. The debate over central banking and its influence on government policies has been ongoing since the establishment of the Federal Reserve System in 1913. Supporters of central banking point to the fact that it provides a stable financial system by regulating the money supply, controlling inflation and deflation, and stabilizing the economy during times of crisis. They argue that central banking is necessary to prevent economic instability and promote economic growth. Opponents of central banking, however, argue that it leads to government control and manipulation of the financial system. They believe that central banks create artificial economic booms and bust, and that their policies are often biased in favor of wealthy and powerful. Some critics also argue that central banks are susceptible to corruption and abuse of power. Despite the ongoing debate, most countries today have a central bank or some form of monetary authority. The role and influence of central banking continue to be an important topic in government policy and economics, and it is likely that the debate over central banking will continue for many years to come. The future of the central banking and its role in the global economy. Central banking has played a crucial role in the global economy for more than a century. The future of central banking is shaped by the changing economic, political, and technological landscape worldwide. In recent years, there has been a growing debate on the role and effectiveness of central banking. One of the key challenges faced by central banks is striking a balance between maintaining price stability and promoting economic growth. With the increasing complexity of the global economy, central banks must also adapt to new challenges such as managing the risk associated with climate change and technological disruption. Another challenge for central banks is maintaining their independence from political pressures and ensuring transparency in their decision making processes. The effectiveness of central banks is also dependent on their ability to communicate their policies and decisions to the public and markets. The use of new technologies such as blockchain and digital currencies is also transforming the role of central banks. Some central banks have already begun experimenting with digital currencies, which could potentially change the way payments are made and financial transactions are conducted. Overall, the future of central banking is likely to be shaped by a combination of economic, political, and technological factors. As the global economy continues to evolve, central banks will need to adapt and innovate to maintain their relevance and effectiveness in shaping economic outcomes. Chapter 90. The Coinage Act of 1870 and Free Silver. The historical background of the Coinage Act of 1870. The Coinage Act of 1870 was a significant piece of legislation in the American history that revised the monetary system and paved the way for future debates about the role of silver in US currency. In the early years of United States, gold and silver were used interchangeably as currency. But in 1834, the ratio of gold to silver was established by the federal government, meaning that gold became the preferred metal for currency. This preference led to the shortage of silver coins, causing issues for those who relied on silver currency transactions. In response to this issue, Coinage Act of 1870 was introduced, which authorized the creation of new silver coins and re-established the legal tender status of silver dollars. This was seen as a step toward bimetallism, or use of both gold and silver as currency, which was favored by many farmers and mining interests. The Coinage Act of 1870 was not without controversy, as some saw it as a threat to the gold standard and believed it would lead to inflation. This debate over the role of silver in currency continued for decades and culminated in the free silver movement in the late 19th century. The Coinage Act of 1817 set the stage for those debates and established a precedent for the government's role in regulating currency. The significance of the Coinage Act of 1870 for the US economy. The Coinage Act of 1870 was a significant piece of legislation that had far-reaching consequences for the US economy. The act reformed the country's coinage system by adopting the metric system and standardizing the weight and fineness of all coins. It also established the United States Mint as the sole entity responsible for producing coins, putting an end to the practice of private minting. The act also played a critical role in stabilizing the US currency system by establishing a fixed ratio between gold and silver. This ratio, known as the Mint ratio, determined the amount of silver that could be exchanged for gold. The Coinage Act of 1870 established a Mint ratio of 16 to 1, which meant that 16 ounces of silver could be exchanged for 1 ounce of gold. This new system had a significant impact on the US economy by increasing confidence in the stability of the currency system. It also made it easier for individuals and businesses to conduct transactions, as they no longer had to deal with the a confusing and inconsistent system of coinage. Furthermore, the Coinage Act of 1870 helped to establish the US dollar as a dominant global currency. The adoption of the metric system made it easier for international trade to take place, and the fixed ratio between gold and silver made the US dollar more reliable and trustworthy. The role of silver in the US monetary system. The role of silver in the US monetary system can be traced back to the founding of the country. The Coinage Act of 1792 established the US dollar as the official currency and defined it in terms of both gold and silver. At the time, the value of gold and silver was fixed by law at a ratio of 15 to 1, which meant that 1 ounce of gold was worth 15 ounces of silver. Silver played an important role in the US monetary system because it was more widely available than gold and could be used to make smaller denominations of coins. As a result, silver coins were commonly used in everyday transactions, while gold was reserved for larger transactions. In 1834, the ratio of gold to silver was changed to 16 to 1, which effectively lowered the value of silver relative to gold. This change was intended to address the problem of silver coins being hoarded or exported out of the country. The Coinage Act of 1870 further modified the US monetary system by authorizing the minting of new silver coin, the trade dollar, which was intended to be used in international trade. However, the trade dollar was not widely accepted outside the US, and many were melted down for their silver content. The role of silver in the US monetary system remained a contentious issue throughout the late 19th and early 20th centuries. culminating in the Free Silver Movement and the Coinage Act of 1890, which required the US Treasury to purchase silver for coinage. The debate over free silver and its economic implications. The debate over free silver was one of the most contentious and significant economic issues in American history. At its core, the debate was about whether to allow the free coinage of silver at a fixed ratio to gold, which would increase the money supply and inflate prices. Proponents of the free silver argued that it would provide much needed relief to farmers and debtors were struggling with failing who were struggling with falling prices and debt burdens. They also claimed that it would increase the money supply, stimulate the economic growth, and promote greater economic democracy. Opponents of free silver, on the other hand, argued that it would lead to inflation, destabilize the monetary system, and harm the interests of creditors and savers. They feared that free silver could cause a loss of confidence in the dollar and that it would make the US currency less competitive on the international stage. The debate over free silver was not only an economic issue but also a deeply political one, as it pitted farmers and laborers against bankers and industrialists. The issue came to a head in the presidential election of 1896, where the Democratic nominee William Jennings Bryan famously declared, "You shall not crucify mankind upon the cross of gold." Overall, the debate over free silver highlighted the tension between different interest groups in American society, and it underscored the difficulty of balancing competing economic priorities. The advocates and opponents of free silver. The debate over free silver involved two groups, the advocates and opponents. The advocates of free silver were primarily farmers, miners, and Western politicians who believed the government should allow limited government should allow unlimited coinage of silver in addition to gold. They argued that this would increase the money supply and stimulate the economic growth, particularly in agricultural sector, which was suffering from low prices. On the other hand, the opponents of free silver were primarily bankers, Eastern businessmen, and conservative politicians who believed that the gold standard was essential for maintaining financial stability and confidence in the economy. They argued that unlimited coinage of silver would lead to inflation, currency instability, and economic uncertainty, which could harm business investment and international trade. The debate over free silver was not only a disagreement over economic policy, but also a reflection of deeper social and political divisions in the United States at the time. Advocates of free silver represented the populist and agrarian movements, which were largely rural and agricultural, while opponents represented the urban and industrial elites. The debate over free silver lasted for several decades, culminating in the election of 1896, which saw the Democratic Party nominate William Jennings Bryan to a staunch advocate of free silver for president. Although Bryan ultimately lost the election, the free silver movement remained influential in American politics and helped pave the way for later monetary changes. The election of 1896 and the free silver movement. The presidential election of 1896 was a turning point in the history of United States monetary policy. The debate over the issue of free silver and its impact on the economy had the most significant political issue of the time, with two major parties taking different stances on the issue. The Democratic Party, led by William Jennings Bryan, was a strong advocate for the free coinage of silver, while the Republican Party, led by William McKinley, was opposed to it. Bryan's campaign focused on the idea of bimetallism, where both gold and silver could be used as legal tender in the economy. He argued that increasing the supply of money by allowing the free coinage of silver would lead to lower interest rates, which would in turn stimulate economic growth and benefit farmers and other debtors who struggled with high interest rates. McKinley, on the other hand, argued that a gold based monetary system was necessary to maintain the stability of the economy and protect the interests of creditors and investors. He believed that free silver would lead to inflation, which would harm the economy in the long run. The election of 1896 resulted a clear victory for McKinley and the Republican Party, effectively ending the free silver movement and establishing the gold standard as the basis for the US monetary system for decades to come. However, the debate over the issue of monetary policy continued to influence American politics, with some economists and politicians still advocating for alternative monetary policies such as bimetallism or even the return to the gold standard in modern times. The influence of the American Bankers Association on the debate over free silver. The American Bankers Association (ABA) played a significant role in the debate over free silver in the late 19th century. The ABA was established in 1875 to represent the interests of the banking industry in the United States. The organization was comprised of powerful banking executives who used their influence to shape monetary policy and promote the interests of their industry. During the late 1800s, the ABA strongly opposed the free silver movement, which called for unlimited coinage of silver at a ratio of 16 to 1 with gold. The ABA believed that such a policy would lead to inflation and threaten the stability of the banking system. The organization argued that the gold standard was necessary to maintain a sound monetary system and protect the interests of creditors who would suffer under an inflationary policy. The ABA lobbied Congress and the public to reject free silver, and its members contributed significant funds to political campaigns in support of candidates who opposed the policy. The ABA's opposition to free silver was one of the factors that contributed to the defeat of William Jennings Bryan, the Democratic presidential candidate who campaigned on the platform of free silver in the 1896 election. Overall, ABA's influence on the debate over free silver highlights the significant power of the banking industry wielded over monetary policy during this period in the American history. The role of William Jennings Bryan in the free silver movement. William Jennings Bryan was a prominent political figure who played a critical role in free silver movement. He was an attorney, orator, and a three-time candidate for the US presidency who gained popularity with his speeches advocating for the free coinage of silver. Bryan was known for his famous Cross of Gold speech, which he delivered at the 1896 Democratic National Convention, where he expressed his strong support for the silver silver cause and criticized the gold standard. Bryan's support for free silver movement made him a champion of the poor and working class Americans who believed that the gold standard favored the wealthy elites. He argued that allowing the free coinage of silver would increase the money supply, which would result in inflation and help debtors pay off their debts more easily. Bryan's populist stance on economic issue won him many supporters, especially in the rural areas of United States. Bryan's advocacy for free silver also earned him nickname the Great Commoner. He used the power of oratory skills to persuade many Americans to support the free silver movement, and he played a pivotal role in shaping the political discourse of the late 19th and early 20th centuries. Although Bryan was unsuccessful in his presidential bids, his impact on the free silver movement and on American politics in general cannot be overstated. The impact of the Coinage Act of 1870 and the free silver movement on US monetary policy. The Coinage Act of 1870 and the free silver movement had a significant impact on the US monetary policy. The Coinage Act of 1870 led to the establishment of a gold standard, which meant the US dollar was backed by gold. The amount of paper currency in circulation was limited by the amount of gold held by the government. This helped to stabilize the value of the US dollar and reduce inflation. The free silver movement, on the other hand, sought to increase the amount of silver in circulation and allowed it to be used to back the US dollar alongside gold. Advocates of free silver believed that this would increase the money supply and make credit more available, which would lead to economic growth and prosperity. However, opponents argued that this would lead to inflation and instability in the economy. Ultimately, the free silver movement was unsuccessful in its efforts to change US monetary policy. The Coinage Act of 1873, which discontinued the free coinage of silver, was upheld by the Supreme Court in 1879. The issue of the silver coinage continued to be a contentious issue in US politics for several decades, culminating in the election of 1896, where the Democratic Party, led by William Jennings Bryan, campaigned on a platform of free silver. The legacy of the Coinage Act of 1870 and the free silver movement can still be seen in modern US monetary policy, and the gold standard was eventually abandoned in 1971. And today, the US dollar is backed by the faith and credit of the US government rather than a precious metal. However, the debate over the role of government in regulating money supply and potential for inflation continues to be a topic of discussion in economic and political circles. The lessons learned from the Coinage Act of 1870 and the free silver movement of current monetary policy debates. The Coinage Act of 1870 and the free silver movement have important lessons for current monetary policy debates. One lesson is the importance of having a stable monetary policy. The debates over free silver led to uncertainty and instability in the monetary system, as investors and businesses did not know what to expect from future monetary policy. As a result, this led to economic stability and slow growth. Another lesson is the importance of balancing economic growth with financial stability. The advocates of free silver believed that increasing the money supply through the use of silver would boost economic growth. However, they overlooked the potential consequences of inflation and the negative impact it could have on financial stability. It is important for policymakers to balance the need for economic growth with the need for financial stability to avoid long term negative consequences. Additionally, the role of interest groups in shaping monetary policy should not be ignored. The American Bankers Association played a significant role in the debate over free silver, and their opposition to it helped to shape the outcome of the debate. It is important for policymakers to consider the interests of all stakeholders in shaping monetary policy. Overall, the Coinage Act of 1870 and the Free Silver Movement provide important lessons for policymakers today. These lessons include the importance of a stable monetary policy, the need to balance economic growth with financial stability, and the role of interest groups in shaping the policy. By taking these lessons into consideration, the policy makers can make informed decisions that promote long term economic growth and stability. So, guys, now the chapter 20 is the American Bankers Association, which is the ABA, and William Jennings Bryan. So, we'll go in detail about their role in the US monetary policies and the ABA's role in debate over free silver and all those things. So that we'll discuss tomorrow. Fine. So today it's time. It's 7 now. And so we'll continue with this book. I think by day after tomorrow, we'll be able to finish it. Now only five chapters are remaining. No, not even five. Four chapters, like excluding conclusion. Okay, it's the nearest. No, the end is near. I was about to say the nearest end. No, the end is near. Okay, guys, I hope you guys learned something in this stream. I also learned. I mean, I knew things, but recollection, right? Recollection of some of the things which I knew. Okay, fine, guys. I'll see you all tomorrow. I'll see you. Bye.